Hello, and welcome to this month's episode of AWM News Update.
Zoa, today should be a very interesting episode as you will take us through the over allocation of private equity, and I'm going to talk about the latest EFAMA quarterly release.
We'll also look into sustainability and passives, an EFAMA policy recommendation, and Fidelity's research report surveying institutional investors about their digital assets. Dariush, why don't you start us off with the EFAMA release?
Long-term UCITS funds bounced back from the volatility seen in Q4 last year with net inflows of 40 billion euros. 5 domiciles saw the inflows totaling above 1 billion euros, with Ireland, France, and Switzerland all above 10 billion. Following the introduction of the new EU regulation on money market funds, we saw flows decline or reach zero in a number of countries, including Austria, Poland, and Portugal. Across the majority of asset types, we saw fairly significant increases in assets. Equity funds increased by 11.7%, multi-assets by 6.6%, bonds by 7.3%. But with money market only increasing by 1%, overall, the total market increased by 7.8% to reach just over 10 trillion euros. Now back to Zoa for Around the Globe.
Thanks, Dariush. Recently, EFAMA also called upon the EU to increase the competitiveness of the European market. Policy recommendations were unveiled for the post-election of European Commissions to discuss.
Some of the recommendations include maintaining the growth of the European asset management sector, keeping regulatory needs consistent with global standards, and avoiding fragmented and arbitrary opportunities. EU firms should not be at a disadvantage to their non-EU counterparts, so the recommendations come as a way to help prevent them from falling behind.
The UK financial regulator also announced that it is prepared to create a financial conduct regulation to diverge from the EU post-Brexit. It will be interesting to see what actually happens here, Dariush, as finalizations come to fruition. Let's find out about actives.
Well, Zoa, the SEC recently approved a non-transparent ETF model in the US. Presidian Investments Active Shares is a new structure that allows active managers to access the ETF market without daily disclosure of their holdings. It would also give fund managers the flexibility to report holdings after a certain time period.
From this, it would let fund managers package their active strategies into an ETF wrapper, allowing for a major tax advantage over traditional mutual funds. As fund managers seize this new market opportunity, they can be more confident that their portfolios will not be replicated and that high-frequency traders do not use disclosed information to trade ahead of time.
The comfort active managers will experience with this non-transparent ETF model bodes well for the active management industry. It holds the potential to deliver increased tax efficiencies and lower costs, which in turn will help the active asset managers attract and retain fund investors. How are passives looking like this month, Zoa? There seems to be a lot of talk about sustainability.
That's right, Dariush. The fund manager's price war is placing a strain on index companies with competition putting pressure on prices. The S&P Dow Jones, MSCI, and FTSE Russell, who control 70% of the market, reflect this pressure as they saw their market share drop from 80% a year ago.
On top of that, Zoa, GPIF is to negotiate higher fees with its passive equities managers. This would help them manage growing stewardship costs and responsibilities. The fund has stepped up its monitoring and assessment of ESG and stewardship activities of external managers. With an AUM of 1.34 trillion US dollars at the end of 2018, more than 90% of GPIF's equity investments are in low-fee passive investments.
Keeping with sustainability, passive funds have increased their allocation to the European sustainable investment market, which has traditionally been dominated by active managers. There is also over 100 billion euro of assets currently invested in passive strategies due to the new solutions and technical advancements.
Sustainable passive funds market share increased over the last 3 years from 4% to 13%, according to Morningstar data. AUM for Sustainable Index and ETF funds also doubled over the past 3 years to 112.2 billion euros. the growth of passives in the sustainable sector is down to recent innovations in the index industry.
We are now joined by Nathalie Donier, PwC's EMEA ESG leader. Nathalie, it's good to have you on the show. We've said that passive growth in the sustainable sector is due to recent innovations in the index industry. Could you tell us a bit more about what these innovations are, and has anything been able to significantly contribute to passive growth in this sector?
Well, ESG integration has been traditionally used by active asset managers, particularly those that were following a fundamental analysis approach. But in the recent years, we have seen that the scope of implementing ESG integration has expanded to quantitative approach, but also to passive approach, with the explosion of ESG indices and benchmarks available. The purist would say that, if you are purely passive, you would not necessarily apply one of the very important aspects of ESG integration, which is engagement with the underlying company to improve their ESG processes. But at the same time, the more we see portfolio being managed with ESG integration being active or passive, the more the stock price is in fact reflecting a premium for ESG good practices. And this is also something that the regulator is aware. And the upcoming regulation that has been set up by the European regulator is in fact recognizing two ways to design product with environmental or social characteristic, either through the use of benchmark or without benchmark. What will be required is that the asset manager must be transparent towards the investor and how is achieving this characteristic through a benchmark or directly without the benchmark, and the benchmark itself needs also be transparent in its approach.
Thanks, Nathalie. I think it's very clear that ESG has moved beyond niche, and as investors demand more in this space, we are likely to see it continue to grow. Over to you, Zoa. What is happening with alternatives this month?
Well, private markets' popularity has increased in recent years as investors search for increased yield and diversification. Investments in private equity are rising, with an estimated AUM of $8.3 trillion by 2025 and a CAGR of 6.9% between 2018 and 2025, according to our estimates. With this rise of interest comes some worries of private equity over-allocation, which in turn could lead to more volatility in public markets. There is also the case of liquidity, as if the market goes into recession, private assets will become extremely hard to sell. Despite this, Mark Machen, Chief Executive of Canada Pension Investment Board, says that asset managers continue to have faith in their private allocations. Warren Buffett also estimates that private equity firms currently have over $1.2 trillion in commitments from investors. Should investor interest in private equity, along with increased competitiveness for significant deals persist, then dry powder levels will continue to rise, falling a record level of $1.9 trillion in 2018. Now to research reports with the latest survey from Fidelity Investments.
Fidelity Investments' institutional investments in digital assets surveyed over 400 institutional investors to find out their digital asset exposure. The research was carried out to gain a better understanding of how institutions, advisors, and investors think when it comes to digital assets. It found that just over a fifth of institutional investors already have some digital asset exposure, while 40% are open to future exposure.
Almost half of the institutional investors thought of digital assets as having a place in their investment portfolios. The survey also links into Fidelity's new cryptocurrency company launched in October, as almost 60% of those surveyed prefer to buy cryptocurrency directly, making it a good time for Fidelity to have such a business to work with. That's all the time we have this month. Why not subscribe and click that bell below to get notified about our next video.
If you enjoyed the video, you can also like or comment down below. Thanks for watching, and with summer holidays coming up, we will be taking a break until September. So we will see you then.